Good Monday morning. This is Drew and Alex coming to you as a sort of podcast today on our newsletter. We wanted to today talk about working at First Heritage, what it's been like the first year. We're coming up on 1 year of employment, and we thought we'd talk about the difference between independent mortgage companies and banks, because I predominantly, in most of my career, except for this period with First Heritage and a period for about 4.5 years after the financial crisis, have worked for banks as opposed to mortgage companies. So I have an opinion about these different models of mortgage origination. So we're going to talk a little bit about that and some construction lending. So Alex, what do you want to say this morning to introduce everybody?
Yeah, I mean, I just think that this topic is often glossed over and is more important than you might think. You know, we're probably going to use a lot of mortgage terms that people don't normally hear, or it sounds a little, nuanced. And if you're not a mortgage lender, you might not quite understand it. But I think that the information that we're giving you today is really important for multiple reasons. One, the most important things in people's lives are shelter, right, which is housing, food, and probably relationships. And we're providing a solution for shelter, housing, and we're trying to give you really good solutions and good guidance on how to accomplish overcoming the obstacle of housing. And I've always felt like one of the reasons that I started working in mortgage financing was because I always wanted to build a home. I thought that would be a really cool thing to do as a young person and have my own custom home. And I eventually did do it, but with a lot of Drew's help and a lot of his guidance. So we do have that result, and I hope that that result can inspire and just be something that it can be possible for you too. Like, it is a possibility for you to also build your own home. And part of that process of knowing how to do it is related to these mortgage nuances that we're going to talk about today, whether it's an independent mortgage company like Drew's talking about that he hasn't really had most of his career in versus a bank type lender where obviously they have more deposits and different variety of products where they don't just offer mortgage financing, but they also offer typically some type of wealth management. You can open up a checking account, those types of things that you can do at a bank. So I thought,
and we don't do those things.
And a mortgage company,
we just do mortgage. That's all we do.
First Heritage Mortgage. That's right. We only do mortgage. And the reason that I came to this conclusion that it would be a good idea to talk about this, because I know I probably won't keep everybody's mindset on this topic, but because it's so nuanced. But whenever you close a mortgage, the mortgage 99% of the time is sold to Fannie and Freddie, right? And so Fannie and Freddie are government entities that basically buy mortgages, just to simply put it. And whenever you do close on a mortgage, most of the time, 99% of the time, you receive a letter in the mail that says Fannie and Freddie have purchased your mortgage. Now, just because Fannie and Freddie have purchased your mortgage doesn't mean that you don't have the original bank or lender that you originally started with servicing the mortgage. There's a part of servicing that's kind of, important here, because whoever's servicing the mortgage is in charge of collecting the payments, making sure the escrow account balance is where it is and stuff like that. And
give them a little bit more nuance. That, like, in other words, Fannie Mae basically guarantees the loan. The bank and buys the loan, gives the money back to the person that lent the money, the bank and or the mortgage company that lent the money, and buys it back. And the company that you're making the payments to is not earning the interest. They're simply collecting the payments on Fannie Mae's behalf and earning a fee that Fannie Mae pays them once a year to do that. And so the lender that you're paying is not really a lender. They're really a servicer.
That's
okay?
Right.
There is what they are. And mortgage companies are really originators, not not really lenders in the sense of what they are. And that's why we're called loan officers or originators as loan officers, maybe.
Right. And
okay.
Yeah. And so well, for example, me personally, just to go back to a real life experience, because I feel like sharing that is a little more potent, is that, I used to work at Citizens Bank. Citizens Bank is who I originally obtained my financing through when I built my house. And I received that letter from Fannie and Freddie, and Citizens still services my mortgage today. And so whenever I make payments, I go to Citizens website and I make the payments through Citizens, right? And there's benefits to working with a bank. That's why Drew spent 25 years at Bank of America, because there are specific products at a bank that are more unique and sometimes just fit the client mold better. And that is called portfolio lending. And portfolio lending, especially for young people like myself that typically just go work for a mortgage company, it's really common for a young person to get out of college who's interested in finance and just go work for Rocket or go work for, a mortgage company that's going to be in a sales room where you make calls with a bunch of other salespeople. Those young people they trip and they miss, and they don't know about portfolio lending. Now, I know a lot about portfolio lending because Drew is obviously my mentor when it comes to mortgage, and he taught me a ton of information, education about portfolio lending. And the reason that this topic has come up today is because I haven't even told Drew really why or what has happened recently about this client that I just closed last month. He was doing a 1031 exchange, buying a house in Avon, and the mortgage essentially wasn't going to get closed because of an outstanding payment due to taxes, right? When you close on a mortgage, they verify that you have paid your taxes or that you're making payment on your taxes. And this client, just for a lack of better words, hadn't made all of his payments for his tax bills when it comes to the IRS. And so
did he know we'd not paid him?
No, he didn't know. But a bank lender would have never have closed on that mortgage without having the payment completed to the IRS. 100% is a hard stop and is a no. Now, I actually closed that mortgage without the IRS paid, which the reason I was able to do that is because when I closed that mortgage, the IRS wasn't paid yet, but we had documentation that the money was going to the IRS. It was in transition. And what mortgage companies do that's different than a bank is that we extend lines of credit to pay the seller. And so what we did essentially as First Heritage is we extended the line of credit to the seller to pay off that current mortgage or pay them for the property, and paid them in full. And then a couple days later, we received documentation from the IRS completed that says the IRS has been paid in full. And we knew that the money was in transition to go to the client, and we were able to close much, much faster because our company at First Heritage extended that good faith and said, we will pay the seller. We don't have the mortgage sold yet anyways. And then I just received an email this week, hey, this loan's been sold, which means the documentation of the IRS is acceptable, because when you sell a mortgage to Fannie or Freddie or to any company, the way that you sell it is you have to have every single piece of documentation for the mortgage to be purchased. And there's a lot of potential issues that arise that we could talk about even longer for audits, because the audits do happen where the mortgage is essentially being purchased, right? But when they review it to buy the mortgage, they say, oh, we forgot a document. We need to get additional documentation about this other transaction that happened, and we need another bank statement. So,
right. Well, I mean, I think you're bringing up some good points. Is that with the difference really for me, and is that in today's mortgage world, couple of things have happened. But in reality, in today's mortgage world, independent mortgage companies have more opportunities to get things done, whereas the banks are sort of stuck in their old ways, so to speak, of doing things. And when I first got into banking, I mean, this was a long time ago. I got in banking in 1985. That's 40 years ago at this point. I became a mortgage lender in 1992. That's well over 35 years ago, about that time period. So, I mean, things have really changed, and the banks really were in control of the mortgage industry. They had the biggest market share. Independent mortgage companies didn't have market share that they had today. There wasn't a Rocket or a Movement or a Guaranteed Rate, three big independent mortgage companies. And today, Rocket's the biggest mortgage lender in America, not Wells Fargo or Chase or Bank of America, And so the independent mortgage companies have really taken huge market share away over the past 25 and 30 years away from the banks. The banks have stayed with their sort of historic process of being, pretty good at portfolio lending, obviously, but they have really hard and fast rules. And, I spent my first 25 years with the company that became Bank of America in banking before I got into an independent mortgage company. And when I left the bank, and this was part of the financial crisis era between 2008 and 2012, I left the bank to go to work for an independent mortgage company because everybody wanted to get away from the banks. And really, this is when the banks probably lost the biggest part of their market shares, because they decided they basically did not want to be a part of mortgage at all. And part of that has to do with the fact that, you are responsible as a servicer for the foreclosure process. So like, this is really can make servicing, we talked about earlier, very unprofitable. And so almost everybody had taken on lots of servicing, and the banks were just trying to figure out how to get out of that. They didn't want to do mortgage origination. So I went to work for an independent mortgage company, but the rules were so tight after that, there wasn't a huge benefit other than just a level of bureaucracy reduction and desire to do business that there is today. So after these past, I don't know, 5 or 7 years, it became evident that independent mortgage companies were being more creative in finding solutions. And we predominantly help people with investment property and second homes first, and primary residences, although we do more of those than we've ever done before, as our other group of consumers that we help. And the independent mortgage companies today just have humongously larger opportunities to help people that we would never have in a bank today. And you want to give them some examples of that, Alice, or do you want me to talk about that?
I mean, I think an example, that you could talk about probably of how we can help consumers where banks kind of fall short is one of those is closing in an LLC. Now, some banks can work around it, is what I would say, but that is one product that we're able to offer very confidently to really anybody that has a credit score and an income and a down payment that meets general requirements. Versus at a bank,
right,
most of the time, that's typically not allowed for the average borrower, to not get too in the weeds of the details. So that's an example of, in our market, we're able to offer that solution much more confidently than we ever could. What's one of the solutions
we also
that you
can really do stuff for self-employed people that we've never had before. Instead of using tax returns, but looking at cash flow through their bank statements, we have more opportunities to help people by using rental income than we've ever had before. And you can do this cash flow stuff to help consumers qualify without tax returns with bank statements for primaries, secondaries, and investment properties. So it's not just limited to one type of property, because some people think, well, I can only do that if I'm buying a house, or I can only do that if I'm buying an investment property. And these programs are really open up to all three categories. And there really are three categories of property that are recognized in this industry: primary, secondary, and investment. There's not anything else. There's not a vacation property type designation or something like that. It has to be one of these three designations to be residentially financed property. So those programs weren't available after I left the bank that we have today, because there was so much concern about, doing loans that might not get paid back. And these aren't no-doc loans, is what, you have to, in today's environment, document some type of income, but it's a way to document income another way versus using tax returns and W-2s for self-employed people. Banks just aren't making these type loans, and they're not going to, and that's understandable. I'm actually glad they're not, because that means we don't have systematic risk. It's not a huge amount of volume in the industry, so we don't have to worry about, the whole country doing just one type of loan program like we did before 2008, and all going in on hog wild on one type of thing, which is really what created the problem in 2008 with basically no documentation, just using credit score. Yeah. So, did you want to talk about construction lending a little bit, Alex?